And welcome back to WealthWise with me, your host, Jordan Kimmel. And we're with an old friend, a great group that I'm really tied in pretty deep with. It's Charles Rotblut, the Vice President of the American Association of Individual Investors, I think the largest of its kind in the country. And Charles, thanks so much for joining us.
Well, thanks for having me, Jordan.
Well, there's so much to talk about, but what I want to do is I want to get into the first piece where people see AAII all the time. Again, with hundreds of thousands of members, you guys put out a survey and you just ask your members, are you bullish or you bearish? And you've created a kind of a moving average or an index on this. Please describe it and please tell us kind of where we are right now in the sentiment of your members.
Sure, absolutely. So our sentiment survey, we've been conducting it since 1987, and the question has never changed. We just ask members, do I think stocks over the next 6 months are going to be up, bullish, unchanged, neutral, down, bearish? So we do have a long history. We have an idea of what's typical, what's not typical. And as of this morning, we actually saw bullish sentiment being above 50% for the second consecutive week. That's the first time we've seen back-to-back readings above 50% since December of last year. And it is unusually high. Bearish sentiment's a little bit below average, but not much. So you're not saying that people are just not bearish at all. It's really neutral sentiment that's unusually low in that sense. It's in the low 20s. So you're almost saying polarization where you have people are very excited about stocks or really think stocks are going to rise, a smaller but still significant group that thinks stock prices are going to fall, and not so many people there in the middle. What we have seen over the history, though, is when sentiment gets too optimistic, we do tend to see the S&P 500 underperform, which is what this is suggesting now. But I should add the caveat that we are right on the cusp of a possible rate cut occurring, would be the first one since 2020. Obviously, the magnitude and timing is still very much unknown, but September's looking pretty good right now.
Right. And I think that your members are actually caught on to something because the market really looked dicey a month ago. 2 months ago, we saw the new lows expanding, the advanced decline line on NASDAQ took out a new low. Things looked actually to me to be dire. Suddenly, before Chairman Powell made any announcement about any interest rates, the market just kind of turned on the dime, made a V-shaped recovery. And again, I think investors have a short memory. And I think that's unfortunate. We need to have a longer memory. And I'm not even sure, Charles, where we are in the cycle of the economy. It's kind of a weird place. But you know what? Our point here with WealthWise and the newsletter, Pro Investor Insights, that you actually are also a contributor to, AAI is, what we're doing is it's the age-old question of whether you give a man a fish or whether you teach a man to fish. And what I'd like to do now is there's so much educational on your news on your website, AAII.com. What I want you to do is you actually sent a note that you had some actionable ideas, the thoughts you wanted to mention. So let's give a man a fish right now.
Sure, absolutely. Absolutely. So the note I sent, Jordan, is just about it's about high yields. And I'm going to look at for two things from the stock side. One is really when you look at stocks, because obviously, as you know, interest rates, it seems like they've peaked and they're coming down. And a lot of people with these CDs, money market accounts, maybe they're getting 4%. We're not so sure how much those are going to actually stay at this level. My mortgage broker just called me and asked me, get your paperwork set up to refinance. So I'm one of those people with this pricey mortgages. Be glad to refinance it. So I was curious. I started looking at, well, what if you really wanted to jack up yield? And so I actually did a search for the top 1% of dividend yielding stocks, the stocks with the highest yields. And their yields are juicy. They're about 10.9% and higher, which I'd like to get 10% income. That's, no risk. That'd be
Don't
nice.
say no risk. Don't say no risk. So tell us. So that was your first screen.
Yes,
But then I know you went further than that.
I did. And so the other thing we actually looked at was we looked at the mutual funds and ETFs with the very high yields. And that second part, perhaps you saw there's an article in the Wall Street Journal several weeks ago talking about boomer candy, which was a new slogan for me. And you've been around long enough. There's eventually there used to be a slogan for everything.
Right.
But these were particularly about covered call ETFs that were being pushed by advisors to basically people in the baby boomer generation to generate income. And I want to point out that I'm talking about the ETFs are using that strategy, not covered call strategies by themselves, because they are different. Because when you're doing your own covered call strategy, you actually have a lot more control. You have the ability to perhaps prevent your stocks from being called if you still want to. When you give it to an ETF, you're putting your hands in their strategy and their
Right.
decisions. So a big difference. So we looked at
It's
that,
a
but
lot
then
less work. It's a lot less work.
a lot less work, right? But not as much control on the tax side. But we
Right.
started digging into other high yield equity ETFs and mutual funds, and it was interesting. One of the things that jumped out to us is they're not tax efficient. For
Mm.
instance, you're giving back about 2 to 4% of your return if you're in the highest tax bracket. So on the one hand, you might be saying, "Oh, I'm getting this nice return." On the other hand, you're getting this bigger tax bill, so you're actually giving up some of that income. So as you said, there's no risk. Well, often you need to lift up the hood and look and see what's going on there. Is it a smooth running vehicle, or is there some sputtering you need to pay attention to? And so what we saw with both is you really need to look at closely, because while you might find some gems, there's a lot of pitfalls in there and some warning signs you need to be aware of.
Right. And so is there an idea, or is it just, the concept? Because we've had, two of our investors that contribute to the newsletter and the show are income investors and do specifically use these high yielding instruments, closed end bonds and ETFs. And, you really do have to look under the hood. I know that AAII, runs a model portfolio,
Hmm.
and you're willing to actually, show individual names. Is there anything after you screened and screened and screened and reduced? Was there anything that came out that you'd say to the listeners, hey, do your own homework, but you might want to look at XYZ?
There wasn't one that really jumped out. A lot of them were very cautious about. I will say the MLP ETFs, if you're wanting to track those types of investments, they're worth taking a look at. Again, you give up some control. On the other hand, not all of them issue a K1, and that's obviously one of the challenges. If you have an MLP, you get a different tax from a K1, and it's not overly complicated. But you either, if you do your taxes yourself, you need to take the time to actually go through it. And you do always have the risk that you could have some return of capital put in with your payment from MLPs, and that starts getting to be a little bit of tax headache and
Right.
more tax tracking.
And those forms tend to come late and they drive everybody crazy. So
Absolutely.
MLPs are eliminated from what I do. Let me go back to AAII for a minute.
Hmm.
And so, you have chapter groups all over the place. And pre-COVID, those were a lot of fun where you get 40, 50, 60 people in every community get together you had, and you had good speakers. And I was pleased to speak at several of the different cities. Are we past enough to start reopening those chapters to live meetings, or is everything still digital?
It's mixed. Some of the chapters are holding in-person meetings. Some have are staying more digital. It really depends on the area. For instance, our New York chapter is very active, but they're doing things over Zoom because, as you know, New York, it's hard to find public spaces to actually hold meetings
Yeah,
in. But I know,
right.
for instance, our LA or our Boston chapters, they're actually holding in-person meetings. So it depends on the geography, but they're also volunteer run groups. So it's up to the volunteer leadership in terms of the venue and the platforms they're holding the meetings on.
Right. Well, it's too long to get into right now, but I shared in the previous segment. We had Wayne Thorpe on from AAII, and the thing I was always enamored with because I like individual ideas. I love the part on your website where you had 60 plus different strategies, and every month you'd run the strategy and see what they picked. And I would go in and I'd look at the picks based upon, who I was interested in. It's a great feeder section for people for looking for individual ideas. And so I point to that, as one part of your site. I'm gonna let you brag for a second. Is this still the largest investor group nonprofit in the country?
It's catering towards individual investors. We still are.
Right, and what are we talking
Yeah.
about? In the neighborhood of 250,000 or so, right?
I would love
You don't
to.
wanna
Actually, we're
brag.
about, yeah, we're actually about 140,000. We'd love
Oh,
to get to
100, okay,
250.
okay.
Yes.
Well, you know what?
Yeah.
Let me just say this, that, what I do is super, super quantitative, and then you look for qualitative, and I subscribe to lots of services. I subscribed to AAII long before I spoke to anyone at the company. And I think what you're doing is super valuable. I know the bullish bear is probably one of the most quoted things every single week.
Mhm.
And let me just ask you this, Charles. There's, the market itself has become a little bit of a, in my opinion, a little bit of a circus with algorithmic trading and stocks moving further than they should to the up and the downside. Any news, and it's not individuals trading; it's computers for a large part of the volume, which is really interesting. Um, but is there anything that we didn't go over today that you think that, hey, maybe look around the corner, you should be thinking of this, you should look at that? Uh, Anything that either AAII or yourself sees right now? Because I'm not good about looking around corners, and I want people to help me looking around a corner. Do you see
Well, I think,
anything you want to share?
yeah, I think one of the things is, I think when you talked about income is, you know, I think when you look at income, you can still get good yields or not high yields, but there's still yields to be had for above 2%. A stock we recently added to our dividend investing portfolio is CME. It's yielding about 2.2%, but it also pays a special dividend. Last year, I think that dividend was probably around $4 per share. I'm going off memory here. But so that's one type of thing where you look at CME and you're like, oh, this is a Chicago Mercantile Exchange. This is not a dividend paying stock.
Right.
But you do have this growing common dividend, which is that 2% yield. But then there's a special dividend that's not factored into the yield. Now, special dividends are discretionary. They may or may not be paid every year, but you have this juicy opportunity. It's a very solid, very strong company. And CME goes down, you're losing a whole venue of trading. So you're looking at almost monopoly type thing in terms of what it's doing. I mean, granted, there's many other exchanges that we have time to list on this program, but I think for income investors, take a look around. You could actually find some good stuff. And the one thing about CME is that its current yield is below its 5-year average. And that's one of the things with our dividend investing portfolio. And you mentioned our stock screens. We actually have some screens that do the same thing. Looking for a yield that's below its 5-year average. Sorry, excuse me, it's above its 5-year average. That tells you
Right.
the valuation's cheaper than it's been. And so there's
Little out of favor.
opportunities like that where, you don't have to stick with utilities or perhaps look for those highest yields where you can find some good yields that are growing with companies a lot more stable than if you're trying to reach for income.
Well, I appreciate the idea. We'll look at it. We always tell our viewers and listeners, do your own homework. But Charles, that's a really interesting idea. And to me, you can't own a treasury and wake up and they increase their dividend.
No.
You can't own a treasury which suddenly is acquired because the valuation was a real good number. And what I always wanted to do, and I've done it at a young age, is steer people towards dividend growth companies. And when you hold the dividend growth companies for 10, 15 years, it is shocking what your current return ends up being on your original investment. And then people have the big problem. They say, well, I don't want to sell because I've got too many capital gains. And that's the kind of problems we like to give people,
Yes, yes,
right?
yes, yes, absolutely. And to your point, when you have a growing dividend, over time, your yield goes up quite a bit because your purchase price doesn't change, but that yield, your dividend keeps increasing. So you might buy a
Phenomenal.
2% yield, but all of a sudden to you, it's now a 10% yield versus your purchase price.
Exactly. And if you even longer, if you stay longer. So
Yes.
unfortunately, Charles, we're out of time. I'm going to say for the record, I am a paid member of AAII. I did the lifetime membership very early. I'm glad I did. And I look forward to joining you, other chapters, having you on periodically. And AAII is a great contributor to the newsletter. So Pro Investors Insights, happy to have you on. We're happy to have you on WealthWise here, and enjoy the rest of the summer. It's almost done. Thanks so much for your time today, Charles.
Thanks for having me, Jordan.
All right, we'll have you again soon. And for now, we need to wrap up. Thanks, everyone, for your time. And great to wrap up another WealthWise segment. We'll see you soon.